Alrighty, folks, it's time to ask. We know that the first half of the year, the stock market is up a whopping 15%. I need to understand what the heck is going on in the stock market. Is there something outside of the stock market that we should be looking at? I think there's a lot of people going, this can't continue. Election, recession, PE expansion. There's lots of stuff out there. We're going to talk to Taylor Life Goal Investments, 10-year Wall Street veteran, and figure out what he is telling his wealthy clients. Taylor, what's going on, man? 15%, not a bad start to the year.
It's been a crazy start for what everyone would have anticipated coming into this year. And even in the last few years, right? So it's interesting. You zoom out right now. You look year to date, 1 year, 3 year, 5 year, 10 year, 15 year. Every one of them is almost exactly 15% annualized for every one of those time frames. And so as you zoom out and you try to use things like from a logical person's perspective and say, okay, 15%, long-term average, everyone knows, is roughly 10%. And so to get back to long-term averages, like we got to have some subdued returns in order to get
Gotta
us
have a
back
pullback somewhere.
Right. I'm not a math wizard, but it doesn't seem like this could continue in perpetuity. And I got a comment. I put a video out that was roughly something around that lens. And someone said, well, isn't that kind of like if you flipped a coin 10 times and it was tails every time, it means that you're saying that it should be heads next time? I'm like, no, it's not. It's not like saying the same thing. There's a little bit more underneath the surface that you can look at to determine that might not be the case moving forward. And to your point, like you look at price to earnings multiple, and JP Morgan draws this beautiful chart out. And basically they plot the price to earnings multiples throughout the entirety of history on the x-axis. On the y-axis, they plot the subsequent 5-year returns. And so basically what you see is a very clear linear regression as to the more expensive stocks are, a higher price to earnings multiple, the lower returns are over the subsequent 5 years. And that's very natural and understandable because if stocks start out from a really expensive place, generally there's a reversion back to the mean on the other side. So one of the things we're doing with folks is just saying like, listen, this has been a meteoric rise in stocks. And had you not owned stocks, you're a fool. Right. And we're not making the argument by any means not to continue to hold stocks moving forward. We're just saying, listen, we should look at some other areas of the market to diversify because, again, 15% doesn't happen in perpetuity. Generally, it gets to 10% as the average over the long term. So we know if you're at 15, you got to go to 10. We know what those returns look like. And then last point I'll make on that JP Morgan graph, not to be a complete scare tactic here, but right now, where the forward price to earnings multiple sits at 20.5 times earnings, if you use the linear regression, and it's a pretty neat graph where the data points pretty well still around that best fit line, it shows a 0% return for stocks over the next 5 years.
Yeah, it's really funny you bring that up because I've read several articles about, the most common article I've read about stock market recently is the lost decade. So here we're talking about half a decade. But I think there's above 50-50 chance that there's at least several years of net zero return, right? And to be clear, just to go back to where I'm comfortable, housing, I think the same thing's for housing. I think we got a couple of years of appreciation.
The fool's gold has all been collected from every asset at this point.
Dude, we got to pay for the sins, right? I think housing is, and I've said this for a year, I think housing will, roughly speaking, be flat on a nominal basis. And if you adjust for inflation, dude, we could have some negative numbers in there. So I think there's a lot of things, the traditional areas, stocks, real estate, that I think there's some sideways, churn coming. But if you're somebody out there chasing alpha or return, what are some alternatives people could look at? Because that's certainly not my area of expertise. It's yours.
Yeah, I think they come in two camps right now. So on one side, you're like, Taylor, if you bring up bonds, you're going to put the entire audience to sleep. You're a moron. But let's think about bonds. So we talk about buy low, sell high, right? Stocks are high right now. And so I don't want to continue to just get over my skis and further risk in the stock market because they're so expensive. Whereas bonds, conversely, if you look at a fact card right now on bonds, it is disgusting. You're like, why the hell would anybody ever invest in bonds? But you have to realize, again, on your zoom out comment from our last little video here, bonds, historically speaking, are incredibly consistent. So you go back to 1976 is when the Barclays aggregate, which is the S&P 500 for bonds, was incepted. Up until 2018, there were 3 negative years in the history of bonds. And the worst one ever was 94. In 94, the bond index was down 2.94%. In 2022, the bond index was down over 13%, which is a 4-time multiple.
Wow.
So yeah, it's been brutal. And we've had 2 of the past 3 years have been negative. And so we've never had this bad of a 3-year stint in bonds. But guys, think about the mechanics behind bonds and why this has happened. What it does is functionally created better return profiles moving forward, because we came from the Fed at 0% interest rates, which is what dictates the yields on all bonds, treasuries, and then you produce a spread over treasuries with the amount of risk in the underlying bond that you're looking at. We went from 0 to 5.5. And when you go up with interest rates, it drives bond prices down because the existing bond in the market has a lower yield than the new one coming to market. So what do people do? They sell it, forcing the price lower and buy the new one. Now we're on the other side of this, right? We're starting from a higher yield rate, and we are looking at future interest rate cuts by the Fed. And so if you're starting with a high yield and the Fed's going to cut rates, that's going to force bond prices higher. And I think there's some really nice areas of the bond market that are being, underutilized right now. And it depends kind of your tax bracket, et cetera, as to what area you go to. But I'll just throw a couple out there. Municipal bonds right now, for someone in the highest tax bracket, triple B, which are investment grade municipal bonds, on the longer end of the curve, 20 or 30 years out, they yield 7.5 to 8.5% on a taxable equivalent basis.
Wow. Okay.
It's okay, if we're talking about stocks not doing a whole hell of a lot of much over the next 5 years, and again, we don't have a crystal ball, but we're just following data here.
Just logic,
Yeah. If you can lock in 7.5 to 8.5%, and then by the way, if we do have yields tick down moving forward, that's going to drive the price higher. That's a pretty good proposition. Another great one, collateralized loan obligations. And this is one, that name gets people's wheels all bent out of shape. CLOs. When you realize this, that CLOs, the 2 highest tranches. So CLOs are when the banks go out and they take all their loans, they put them together and they package them in tranches on level of risk. The highest 2 quality are AAA and AA. AAA and AA collateralized loan obligations over the past 30 years, there's been 4,316 issuances. Oh, wow. 0 have defaulted. Right? That takes you through 2008, 2009 in the bloodbath. And right now they yield 6.7% on an asset that's never defaulted. And again, if you look at the stock market and go, hey, we're not expecting that much over here, 6.7% with something that's never defaulted, I don't know. That seems pretty darn good. And then you could come down a little bit in your level of quality and still have incredibly low default rates and still have significant returns. Another area of the market, infrastructure bonds. So infrastructure bonds are a very interesting space right now, where the index of infrastructure bonds right now yields 10.9%.
Oh, wow.
Default rate 1.2% over the past 30 years. A fraction of the default rate of corporate bonds. What are infrastructure bonds? They're roadways, there's tunnels, they're bridges, they're data storage facilities, cloud computing, all of those things. Oftentimes it's a public-private partnership. PPIP is what they call it. So you've got some government backing, and then you have inflation kickers on top. So those are some areas, and then I'll just throw a couple more and just fireball them at you. Farmland. Farmland literally has an index, goes back to 1994, annualizes 10.6% annualized return, has never had a down year.
So farmland, there's actually an index. Do you know the symbol?
There's no ticker symbol for it. It's an institutionalized space. And that's why it's tougher to get investments into the farmland space. But there are vehicles out there that can do it. And again, like 2008, for example, S&P's down 37, farmland's up just under 16%. 2022.
Farmland makes a lot of sense to me. It's not something I've heard.
Who is the #1 owner of farmland singly in the US right now?
Gates.
Bill Gates. And I talk to people, I'm like, listen, You might say, hey, he's got some environmental whatever going on. Okay, I get that. The reality is, zoom out, he owns $50 billion in Microsoft stock. He owns $50 billion in municipal bonds. And the best offset to those two risks is farmland. It's a
Farmland.
great inflationary hedge.
Couldn't agree
So
more.
there's that. Timber for there's a lot
Yeah.
of opportunities out
Well,
there.
so other alternatives. I mean, when I was growing up, gold was
Mhm,
the hedge, and in today's youth, it's crypto.
mhm.
What do you think about either gold and or crypto as another alternative to stocks?
Yeah, I don't see. So gold, yes, I think that's a pretty decent diversifier because gold works in 3 different environments. So if you break the economic cycle into 4 different environments: growth,
Okay.
inflation, stagflation, recession, gold works in 3 out of 4 of them.
Hmm.
It works in inflation, stagflation, and recession.
Yep.
So we love gold as an overall piece of the equation. Another one that's a great inflationary hedge that we own inside portfolios, not because we love oil, is oil. So if
Yeah, of
you
course.
rewind back to 2022, stocks and bonds, the 60/40 had their worst year ever. They got smoked on both sides.
Yeah,
What
it
did
did.
really well? Oil. Because guess
Yep.
what caused a lot of the underlying inflation? Oil. Russia invaded Ukraine, constrained supply. You in California are paying like $58 a gallon for oil,
Exactly. Not quite
right?
58, but 54. Thanks, Newsom. Yeah. Yeah.
So there you go. But that's a nice offset. Bitcoin, I don't see as the same thing. I understand the narrative is there that it's the new age gold, etc. I think that more
Well, I
realistically,
don't know if so. Hold on. It's really funny. There's a Bank of America survey you may not have seen, but I'm sure you can look it up. That did a survey of 2 different age groups. It was 43 and younger, and
okay,
44 and older.
okay,
And I just talked about it this morning. 44 and older, my age group, we have 1% of our assets in crypto, which makes sense. I have 1% of my assets in crypto. It's an insurance hedge. 43 and younger, 15%.
that's a
And
bigger
actually,
number than I would have expected, honestly.
that's what it says. You should look this up. And here's the big bugaboo for you, right? A Wall Street guy. And I'm trying to get my sheet, but I'll go from memory. Stocks, my age group, 44 and older. 56% of our wealth is in stocks,
Mhm.
27% for 43 and younger. So if this
Interesting.
is a trend that continues, you got a lot of folks, like millennials are getting older every day. I don't know if it's a distrust of the stock market. I don't know if it's,
Yep.
hey, it's a peak. I don't know if it's a FOMO, but there is a clear, I mean, you should find, I'm sure I read a summary article. I'm sure there's a lot of meat on the bone you could go get, but
Yeah.
you all better be paying attention because the younger group is not all in on stocks.
No doubt. And I think that I'll use your phrase from our prior video on a zoom out basis. I think that that might change because
Oh,
you
sure.
look at the fact that crypto has been on an absolute moonshot over the past year, so that might have just compounded. But nonetheless, there is no doubt in my mind that the younger demographic is very comfortable with crypto. The way I see crypto, and this is a fair amount of information backing this, is zooming out just a little bit. You can't look at it day to day. You can't look at it month to month. But if you look at it quarter to quarter or year to year and you zoom out, crypto tracks the NASDAQ
Yeah,
incredibly closely.
I've seen that.
It's on top of each other. And so, but it has what the
And
measurement
specifically, it's the NASDAQ 100, if you want to get really specific.
correct. It tracks tech stocks, right?
Yeah,
So
exactly.
you look at it and say, hey, the beta, which just measures the magnitude of a move, is like 3x. So tech stocks are up, it's up 3x. Tech stocks are down, it's down 3x. And you go back to the inflationary conversation. What was the worst year for inflation in the past 50 years? 2022. What was the
Mm.
worst year for crypto in the past however many years? 2022. So it's
Yeah.
like, is it an inflationary hedge? I don't know. It hasn't acted that way.
Doesn't feel like it. I will give you that one. One of the things that, again, I started researching crypto in 2018. I had a buddy of mine who's an 8-figure investor and all that nonsense. And he got me to get to 1%. I was like, okay, I'll buy an insurance hedge. And I bought the hook, line, and sinker. It's an inflation hedge, right? There's a limited supply, all that stuff.
It makes sense. Yeah.
Yeah, I mean, again, right? Logically speaking. And then we go through 2022, and I'm like, well, does it feel like an inflation hedge to me?
In his defense and in crypto's defense in general, gold really didn't act as an inflationary hedge that year either.
I'm not
And
a, I'm not a, look.
and zoom out, it typically has. But yes, you're right. You know, that definitely didn't. Gold did not as either. So yeah, it's an interesting little paradigm there to figure out exactly how Bitcoin fits in, where it fits in, et cetera. 1% position like you have is inflation or a kind of insurance hedge, as you're calling it. Totally. I
Yeah,
get that. One of the things that you're seeing right now is Bitcoin's experiencing a little bit of pressure via a Japanese company that went through
I saw that.
bankruptcy that's
Yeah,
now
10
dumping.
years dumping. Yeah.
Yeah, dumping. And I read an article on this. It was so well put. They're like, the people that were involved in this bankruptcy who had assets on that platform don't understand how lucky they are to be forced to have held
For
Bitcoin
10
from
years. Yeah.
then until now. But there's also the other kind of scare fear tactic out there when it comes to Bitcoin is the US government holds a pile that they've confiscated. German government, European governments own piles of it. And it is the supply constrained game. So if the supply constrained, you know, they're at one point ends up being a little glut in a short term, it's going to provide some price pressure. I think you're seeing a little bit of that recently.
Yeah. It's really fun. I think there's always other areas you can look at. You don't have to be stocks, don't have to be all real estate. There are lots of other areas. And what I love about what you're doing, Taylor, is you're putting out daily content on Instagram, little 60-minute clips to help people. Where can they find it?
Yeah, find them at Life Goal Investments. We're on both Instagram and on TikTok.
Thank you, buddy.